morning, everybody. It's Wednesday, January 31st, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to your question during the show. Quickly overnight, markets had March corn down 2 1/4 at 445.5. March soybeans were down 6 at 12.12 3/4, and March Chicago wheat was down 8 1/4 at 597 1/4. Excuse me. Starting out here this morning, we were looking at Argentine weather yesterday midday. Maps flipped a little bit drier in the extended 10 to 15 day outlook. Here this morning, as we come in and start looking at models, I think the euro got a little bit wetter in that time frame. So shoot over to Dustin, maybe talk a little bit about the weather, some of the trade that we had yesterday, and the overnight reaction. So good morning, Dustin.
Hey, good morning, Dan. Thank you. Yeah, we've been talking about that Argentine weather. The 2-week forecast has been very hot and dry. We've had that in our letter as well. There was a shift overnight on the euro models. So the euro model got about 21% wetter than where it was yesterday. So we're about 80% of normal rainfall projected for the next 14 days. And so that's a notable shift to the positive, and that's partly why we're going down overnight. We've also had some negativity in the outside markets that may be playing a factor as well.
Yeah, I know we're going to have a Fed announcement today ahead of the end of their January meetings. By all estimations, not really expecting any sort of a rate cut, but rather a guidance on down the road potentially for May or June, I think is where they're targeting if things all line up. But data is still showing that they're punting a little bit on rates. Is that your opinion?
Yeah. So, there was a huge shift here in the last couple of months from being, overly hawkish, being super, cautious to talk about the pivot because, it could be the same thing that we had, back the last time we had double-digit inflation rates was they pivoted too soon, or they weren't hawkish enough until they really had to take rates well into the double digits to convince the market to start pricing in inflation lower. And we're going into election year. I think there's a lot of discussion about that. Is that all of a sudden we're seeing the Fed pivot quickly, and the markets responded very positively to that. The dollar's been a negative thing for the dollar, and maybe that's one strong point for commodities to watch. When we get to these types of dates, it's all about looking at what the guidance is from Fed members and how the market responds to that. If the market's convinced the Fed truly is pivoting and we're going to go right into that rate cutting at an aggressive pace for the rest of this year, then that's what's going to take the dollar and have a larger impact on dollar-denominated assets, including commodities. So I think watching that response is probably the biggest thing. The dot plots and the guidance, that's one thing, but how the market responds is another, and that's probably more important.
Yeah, sure. One thing coming in this morning, I'm sure I'm not alone, but a pretty impressive pop yesterday, in our markets and commodity markets. It was nice to see beans up over 25 cents in the cash markets, and here we are again this morning, we finished off the lows, but at the same time, a little bit lower this morning. And so thoughts on that, guys, posting and some talking about posting a key reversal yesterday in corn. And, if we trade weaker today, that's not a real positive sign, from where I'm sitting.
Yeah, no, absolutely, Dan. Key reversal. The one technical aspect I wanted to shout out to everyone is that March beans 33 3/4. We have not settled above that since the day after Thanksgiving. So I think if we get above that, we can definitely probably get some short covering, but just one number for everyone to look out at. That's kind of a target right now. So
Well, and if you look at the way we traded yesterday, I mean, if you did get, another flip in models or, things got a little drier midday or something, you're not far off from breaching some of those levels. Again, like
Right.
we've talked about a number of times, having orders in and things like that to catch up on sales.
Yeah, absolutely.
Yeah. I mean, to add on to that too, we're getting a lot of calls yesterday with the rally with the growers. If you wanted to catch up on old crop sales, I mean, you got to be on the defensive. Is it either it's weather, it's technical, or what? I think now is just more time to generate revenue than anything. So I would just look for that, put targets in. With the thing that we've been seeing too is you're going to get some hot bids on basis too. Either with flat price being low, but like Northeast Iowa, I'm showing. If you get a hot bid of 20 over, now you're actually in a pretty good revenue spot. So sometimes got to think out of the box and just get that revenue moving.
Yeah, I was going to add to that, Brian. I think you make a good point. That talking to a lot of elevators across Iowa, Illinois, almost the whole belt, they're still saying this is the most undersold for this time of year they've seen their growers.
Right.
And it's if you're in that spot or you got corn or beans that you want to price between now and before harvest, let's say, there's also a bunch of other people out there with the same need. And if you're seeing some good basis levels now, it's probably because of that lack of, those bushels being held back right now. So I think it's important to sit down and make that decision of, are we going to hold these bushels well into the spring and summer? And maybe there's some opportunities there to catch some carry and see some basis pushes then. But if you're in that boat where you need to generate some revenue in the next month or two, you really got to take into consideration that you got a good basis, and you don't want to be forced to sell when everybody else is continuing to sell,
right.
In that time frame. So that'd be my thought.
Well, and that falls along too, Dustin. I mean, we've been talking a lot about spreads, right? The fact that we still feel that with what we know, and to Jason's point, the farmer's still holding a sizable cash position. Spreads are pretty narrow. Wouldn't you agree for what we know about that for this time of year?
I think so. I mean, it's not in the eye of the beholder, but we have, new spread rates that we haven't really been able to test since they were first implemented Dec of 19.
Tell me a little bit about that real quick, Justin.
Yeah, so just the warehouse receipt costs approximately going from 5 cents a month prior to that contract, Dec 19 contract, to 8 cents a month. And that's, if you're going to take delivery, you have to put up the full value of the contract, take the receipt, and then you're to manage that receipt. It's a daily rate that comes out to be approximately 8 cents a month of cost. So if you're talking about, risk-free rate somewhere around that 5 to 5.5% right now, your monthly cost is going to be somewhere around that 2 cents a month for corn, for example, and 8 cents a month on top of that for maintaining warehouse receipts. So full carry is just over 10 cents a month right now estimated. And if you figure that compared to where we are right now, from let's just say March to May or March to Dec, however long you want to look at, we're pretty low on the percentage of full carry terms. We still have a ways to go. We had yesterday, coming into yesterday, we had new lows being met in the July D spread, and we had a rebound yesterday, of course. So there's still a positive correlation between rising prices and narrowing spreads and falling prices and widening spreads. We just think that as more old crop changes hands from grower to end user, and that grain finally starts moving, we think this, again, is going to happen as we get into first notice day time frame. We'll especially feel this, we believe. This is opinion right now. And that there's a good chance that we see spreads go and test a wider level than they normally would. And that really kind of has to change hands through ownership for that to happen. You have to get more participants actually changing hands. We saw this in the September contract going into September first notice day. We saw this in the December contract going into December first notice day. There's a lot of people that have different opinions about this because river levels were also quite low during that time frame. So they think, well, that was just an anomaly. We think this is just the first year we actually have to carry out to test these rates. and that there very well could be another repeat of that as we go into the next couple of first notice days.
Okay, so this isn't this isn't just going to be coming into February. I mean, this is something that could continue to shake itself out through that May-July timeframe, in your opinion, or?
Yeah, cash is king. So we need to raise cash, and so growers aren't going to hold this 2.4 billion bushel carry out, willingly, right? They're wanting to raise cash right now. So that's where the change of ownership happens. Is we need to raise cash. That grain starts moving. We need the market to say, hold up, we don't need all of this grain at once now. Right? Once that grain finally starts moving, there's going to probably be more people that want to move it, in our opinion, than what the market's ready for at that time. And so I think there's been a lot of surprise just from different commercials that we talked to, that they haven't had as much flow as they expected. And I think that's because growers have come through. They came in with strong balance sheets. They had a lot of cash from the prior couple of years, and they were able to hold on to that grain a little bit stronger coming into that time frame. So we keep hearing estimates of lower percent sold than what a lot of people were anticipating. And every grower delivering against contracts they had previously made, as those contracts run up, they're a little bit more reluctant to wait, or reluctant to deliver that next bushel until they get the price they want, right? Well, at some point, we all need to raise the cash, though. We've got bills coming due. As growers feel that and say, basically, okay, I'm at the end of the line here, I have to start selling, I think that's where you start to see that spread widening. This is, again, huge market opinion, so I want to put huge asterisks on this. It could easily go the other way, too.
Sure.
But I think that setup is there, is my personal belief.
Yeah, that's good stuff. And to that point, it's like you guys have been discussing for weeks now, but could that lend itself to some support in the back into that these 24 type of time frame, maybe carve out some sort of a floor, if you will, in that new crop contract?
Relative support, relative to new, so it like I said, it's when I say spreads and flat price have been positively correlated, that means that spreads have been going down as the price has been going down. Spreads have been rising as price goes up. So you're generally, we call that like the front of the roller coaster. The front market is getting the most attention. We've seen it in other scenarios where they haven't been positively correlated. Like a famous one would be like the July 08 contract, where we actually, on our way to $8 corn in 08, during that big run up early on in the year, we actually moved the July of 08 contract towards full carry against the D's contract. And the reason we did that is we killed demand on that July of 08 contract. We still had a carry in, but demand was starting to pencil in negative margins. So they said, hey, we don't need this corn that bad, right? We're not going to buy it at these prices. And so the market literally went to a decent carry. If you're in a situation where prices start to rise because you have not enough corn acres next year, in the appeal to go plant more bean acres, which is, again, another opinion. Yeah. D's corn could actually could show some support there. All right. That's the contract that needs to prove something, in my opinion. That's the one that needs to try to convince growers to plant some more corn and corn. And if they don't need that, if it's because we have too much supply, well, again, that's where the market says, hey, we don't need all this corn at once. Right. We need growers to store this. We need to provide that financial incentive for them to do that.
Well, and at above 2.6 or beans at $12 or whatever that number is, I mean, now you've got a viable case for that to happen, right? And yes. Maybe it doesn't show up in March, but maybe that they're, it's going to be a decision that they're really going to have to look at.
Yeah, I mean, we always want to know what the future beholds. I think right now is one of those special times where we really want to see what happens over the next 3 months, because there's something there is a bit of a question about, do we have too much supply carried in from the prior year, or are we really going to put growers into a negative margin situation by this much going into the insurance price window, and then not see any sort of acreage implications on that? Because right now, most of your surveys, your USDA estimates, private estimates are still calling for a pretty good amount of corn acres. 93 million plus corn acres I've seen a number of times.
Yeah, which would be plenty. I mean,
in these margin environments, in my opinion. So
right. No, that's a good point. Quickly here, guys, to wrap up, got a cattle update. I visited with Ryland last evening, and we've got a real big cattle report today at 2:00 Central Time. The report set up right now is pretty bullish. The cattle herd is expected to be the lowest since 1951 at 87.58 million head, which would be down 2% or 1.7 million head from the same time last year. As it relates to beef cows, they're expected to be down 2.6% year over year at 28.92 million head. And the total 23 calf crop is expected to be 33.67 million head, which, if realized, would be down 2.3% year over year. Bottom line, in Ryland's opinion, is heading into the report, we got very tight cattle numbers in front of us, and these herds need to be rebuilt. He is going to have his reaction to the report in his evening commentary, and I'm sure we'll discuss this report amongst other things tomorrow morning here in the War Room. As we come into the open here this morning, we got March corn down 2 3/4 at 445.5. March soybeans are down 5, 1213 3/4, and March wheat is down 7 at 598.25. One administrative item to talk about before we wrap this morning. Next Tuesday, February 6th at 2:00 Central Time, Dustin and the team are going to go through ARC and PLC decisions, data that we're going to go through, talk about how this pertains to the decisions that the growers have to make. It's going to be exclusive content, so pre-registration will be sent out to AgYield consulting clients for that show. And if you got any questions about registration or anything, as always, please don't hesitate to give us a call. Every day that the markets are open, 8:15 Central Standard Time, we are streaming live on X, Facebook Live, and YouTube Live. We will be back tomorrow morning, same time, same place. Hope everybody has a great day, and we look forward to talking to you soon. Thanks a lot.
Thanks, Dan.
Thanks, Dan.